Welcome back to the Wall Street Podcast. Today we're doing a deep dive into the Flow Show. It's a comprehensive analysis from BofA Global Research, just released on August 28th, 2025.
Exactly. And this report, well, it gives a really detailed look at year-to-date asset performance, the weekly capital flows across different assets. It also covers BofA private client allocations and provides quite a range of macroeconomic and market insights through specific data points. Our goal here is to sort of distill all that down into actionable knowledge for you and keep it concise.
Okay, let's jump right in. Starting with the year-to-date lucky numbers from the report. Gold is leading, up 30.5%. Then you've got Europe stocks at 24.5%, Bitcoin doing well at 19.5%, and U.S. stocks are up about 10.3%.
Right. And on the other side, the underperformers.
Yeah.
The U.S. dollar is down 9.8%, and oil has dropped 10.3%. So quite a spread there.
Definitely. Now, what about the latest weekly flows?
Okay, so weekly flows, bonds saw $19.7 billion come in. That's actually the smallest inflow in about 4 weeks. Stocks got $16.6 billion, cash received $6.8 billion, crypto pulled in $3.1 billion, and gold saw $1.4 billion.
Interesting about the bonds slowing a bit. Anything else stand out?
Yes, Europe stocks actually saw an outflow of $1.2 billion. That's the first time we've seen 2 consecutive weeks of outflows since, well, February 2025. On the other hand, financials had strong inflows, $2.9 billion, and tech also added $0.3 billion.
Got it. Let's talk about BofA private client allocations. That's, what, $4.1 trillion AUM?
That's right, a significant pool of capital. Their allocation is currently sitting at 64.2% in stocks, 18.2% in bonds, and 10.6% in cash.
And the report highlighted something about treasuries.
It did. A record weekly inflow into T-notes, so that's the 2 to 10-year treasuries. And there's been a noticeable shift since 2023. T-bills, the shorter-term ones, are down $28 billion in their holdings, while T-notes are up $14 billion. So clients seem to be extending duration a bit.
Makes sense. What are they buying and selling lately?
Recently, these private clients have been buying industrials, investment-grade bonds, and mini ETFs, and they've been selling healthcare, energy, and staples. Kind of a pro-cyclical tilt, maybe?
Okay. And the BofA bull and bear indicator, still neutral.
Still neutral, yeah. Holding steady at 6.0, this seems to be influenced by a couple of things pulling in different directions. You've got slowing inflows into high-yield and emerging market bonds, and also falling global stock index breadth. So fewer stocks are participating in the rallies.
But offsetting that.
Offsetting that are stronger overall equity inflows and the fact that cash levels in the fund manager survey are pretty low. So mixed signals, keeping it neutral.
All right, let's shift gears into our commentary modules. First up, the macro and fiscal picture. The report points out 91 central bank rate cuts globally in 2025. That's the fastest easing cycle since 2020. But this is happening against a backdrop of, well, record U.S. government debt at $37 trillion. So how do these two big trends, aggressive monetary easing and ongoing fiscal expansion, shape the economic outlook, especially with U.S. nominal GDP up 52% in 5 years?
That's the core tension, isn't it? The rapid easing, well, it's partly driven by the need to stabilize government interest payments. The report even suggests a 5-year Treasury yield below 3.25% would be needed for that stability. And that 52% nominal GDP growth over 5 years? It's the fastest since the 1970s stagflation era. Critically, the report notes that 28 percentage points of that 52% came directly from inflation.
So more than half of that headline growth was just rising prices, not real output.
Exactly. It signals that a large chunk of this expansion isn't real growth in the traditional sense, which certainly echoes challenges from past stagflationary periods. Okay, moving to our second module, market dynamics and these structural shifts we're seeing. The S&P 500's price-to-book ratio is at 5.3x. That's the highest it's been since 1946. And its trailing PE ratio, 27.4x. That level has only been exceeded about 2% of the time in the last 125 years.
Wow, really elevated metrics.
Very. And this is happening while the so-called AI Big 10 now make up 39% of the entire U.S. stock market cap. Plus, we have a record $7.2 trillion sitting in money market funds. So what's this telling us about investor sentiment and where things might go?
It's quite the paradox, isn't it? You have these historical extremes in valuation and very high market concentration in just a few names, driven by AI excitement. But then you have this mountain of cash, $7.2 trillion parked on the sidelines in money market funds, that suggests either a lot of caution out there or maybe significant dry powder just waiting for, well, maybe better entry points or more clarity.
Right. It's a real tension between parts of the equity market looking quite stretched and this huge amount of undeployed capital. Definitely something to keep an eye on.
Okay, let's move to our third module, societal and tech trends. These often feel a bit removed, but the report connects them. It notes that Gen Z and millennial voters actually surpassed baby boomers as the majority voting bloc in the 2024 U.S. election. We're also seeing a jump in the U.S. graduate unemployment rate, 8.1% over the last 3 months, which is quite high for graduates.
Mm-hmm.
And technologically, AI is projected to double global data center power demand by 2030. Tied to that, U.S. electricity prices are already up 6.3% in the past year. How do these kinds of broader shifts really translate into tangible impacts for, the average person in the economy?
Well, they connect directly to daily life in several ways. The shift in voter demographics, for instance, will almost certainly reshape political priorities and how resources get allocated over time. The graduate unemployment rate that directly hits the career prospects and financial start for a whole generation. It impacts consumer spending, household formation, all sorts of things.
And the energy aspect.
And the energy piece, driven by AI's increasing demands, feeds directly into household budgets. Higher electricity bills affect the cost of living for everyone. It's a clear link between big tech trends and your wallet. So, pulling it all together, what does this mean for you, the listener? These statistics aren't abstract. They directly influence things like the purchasing power of your savings, given that inflation component in GDP growth. They affect career paths, especially for younger people entering the workforce. And they impact your basic cost of living through things like energy prices.
It really paints a complex picture. This deep dive shows this intricate interplay of monetary policy, these very high market valuations, and these broader societal shifts. It suggests that the underlying currents, the deeper changes, might be much more significant than the day-to-day market movements we often focus on. The real question becomes, how will these profound shifts redefine investment strategies and, indeed, our daily economic realities in the years ahead?